Well, hello, Vetted VA. Nathan Nottingham here with Vetted VA with our good friend Hammer J. Helmer, talking about the mortgage market updates. Back from vacation with what a week it was. There's a lot going on. I mean,
What a,
a
what a
lot, a lot.
time to what a time for us to skip a week, right?
Yeah. If you're going to if you want to get busy, take a vacation. And apparently, if you want to be in mortgage market updates, go ahead and take a vacation and just see what happens. Like, hold on, everybody. Here we go.
Yeah, absolutely. So, all right, well, let's dive right in. If you don't mind, go ahead and share your screen. I
Got it.
love the new graphic, by the way. So let's remind everybody, we know, especially when you take a week off, we know that you may not be here watching live. However, we do
Mm-hmm.
work hard to get these out there for you each week. Remember that you can come back and check the Vetted VA group and look for these posts. If you'd like some insight into what's going on in the mortgage market, feel free also to ask any questions you guys have. As deep as you want to go, we'll answer. So
Yeah.
if you want to know more about what's driving markets or kind of get a different view, especially those of you that may be looking at media sources, the media sources can really not mislead you on purpose, but they can mislead you. They're usually quoting either outdated or biased information. When I say biased, most of them quote the Freddie Mac survey, and let's actually just for a minute let's talk about that, because I don't think we ever have. So
Mm-hmm.
what happens is the company Freddie Mac, they are one of the companies that securitize mortgages, and they do a survey every week, and they send it out to a large number of lenders. I forget what the exact number is. They tell you all about it here in the survey participation. You can read about this and kind of what they do and how they've done that. But they do the survey and they send it out and they say, okay, what rate are you quoting? And what happens is these lenders fill out this survey. And for example, right now it's saying, well, hey, 30-year rates are at 5.78%, but then it's showing a 0.9% fee or point. So it's basically it's going to cost you a point to get that 5.78. Now, this survey was last week and
Hmm.
not the current information. So it's always running behind. And what we saw over the last 10 days, we've seen mortgage rates move anywhere from a half a point, sometimes 3/4 of a point, even a full percent higher in a course of just a few days. And we're going to show you why that happened. But when you look at one of these surveys, it can be very misleading because you're trying to compare what rates you may be getting that day compared to
Yep.
what was on this survey. So when it comes to this, a lot of the media sources are quoting these, and it's not that they're purposely misleading you. Like I said, it's just the data they're sharing and the points that they're making may not really be accurate, and they may not really be relevant to what you're seeing, especially if you are also getting a VA loan. You're going to see a different reaction than what we're generally talking about, which tends to run more along conventional financing. Conventional
Right.
financing, that term conventional means the mortgages that are being sold to Fannie Mae and Freddie Mac, which don't include FHA loans or VA loans. VA loans are actually guaranteed, a certain portion is guaranteed, and
Yep.
they are sold actually as a different security through a Ginnie Mae security rather than a Fannie Mae or a Freddie Mac. So a bunch of funny names that we have floating around there. And what the bottom line for you guys is, even though I talk about the mortgage bonds backed securities, because it is relevant through all markets, you actually will see a little bit of a difference in some of the VA loans, specifically, especially when it comes to that rate quoted by Freddie Mac. So that's just a little tidbit for you. Let's go ahead though, and I'm gonna go back to the slides here. Let's talk about quick recap what happened in the last couple of weeks, and I'm gonna dig deeper on this. But for anybody that just wants the abridged version, you just want a summary. Let's talk about what happened. So Friday, June 10th. I have to go all the way back to Friday, June 10th, almost 2 weeks ago, and talk about
Mm-hmm.
the fact that we had inflation data come out, and that inflation data, it was higher than expected. Now, my opinion wasn't really that much higher, and basically what investors were looking for, they were looking for signs that inflation was getting under control, because the Fed has already raised that Fed funds rate, the policy rate that we talk about. That again, the Fed doesn't set mortgage rates, but they control this Fed funds rate. And the Fed has already raised that rate. In March, they raised it 1/4%. And in May, they raised it 0.5%. So investors, markets were looking for that June 10th inflation data to show some kind of reflection. And it might have been a little premature to even look for a reflection on that. Sometimes it can take a few months for those reports to really reflect moves. So anyway,
Mm-hmm.
the inflation data came in a little bit stronger than expected. And it just set off just a whole box of fireworks. It was like throwing a lit cigarette into a box of fireworks. And Friday was a terrible day. We saw mortgage rates move. And, again, even me as in tune with this as I am, sometimes I get it wrong. And Friday was one of those days that I got it wrong. My advice on Friday, June 10th had been, don't lock anything in. We will generally see a rebound. We'll see things improve after this really bad day, because if you had gotten quoted a rate on Thursday, the 9th, and then quoted a rate on the 10th, you would have seen that rate probably about a 0.25% higher. Nathan, does that sound right? If you remember, thinking back, because about a 0.25%, it was a big jump on that Friday.
Yeah, it was. No, you're right.
And then, so, what happened was we said, okay, well, let's wait till next week. Cause I've been saying to you guys for the last few weeks, things should, they've really settled down, and they had, and there'd been nothing on the radar to, really show us that we were concerned. Well, once the markets kind of built some negative momentum here and market sentiment took over, and one thing that's bad in any kind of warfare is emotion. And when it comes to financial warfare, emotion is the worst. Emotion took over, and man, the markets have just, on Monday, they got worse. Tuesday, they got worse. And it was, when I say markets, I mean everything. Stocks took a beating. We went from, a bull market to the bull market to a bear market. Bonds took a beating. So all of these financial instruments, and what happened is rates across the board were just moving up, including mortgage rates. And rates had moved so far that some people have seen rates in the sixes. And that doesn't mean you're being taken advantage of. That is what we are seeing. So quick recap, rates moved higher last week, with the highest rates coming early in the week, Monday and Tuesday. And that was before the Fed meeting that came out on Wednesday. And I've talked about the Fed meeting, and the Fed is really the one thing that's affecting, not controlling, but affecting mortgage rates the most right now. And it's the idea, there's two opposing fears that are going to either hurt or help mortgage rates. One is fear of inflation. The fear of inflation hurts mortgage rates. It pushes mortgage rates higher. Fear of recession will help push mortgage rates lower. And we'll talk more about that in a minute. But on Monday and Tuesday, the rates had moved up to some of the highest levels that we've seen. And since 2008, the highest levels we've seen in about 15 years. And the Fed meeting on Wednesday, we did see things improve, and I'll talk a little bit deeper about why that happened in a moment, but we did see some improvement as markets reacted to the previous week's inflation data. The Fed did raise their Fed funds rate by 0.75%, and I'll explain what that means in a moment, but it was a significant increase meant to fight inflation, and it actually helped mortgage rates improve on the week, coming down slightly from the worst levels we've seen since 2008. Now, the forecast this week, when I did this on Monday, and today's Wednesday, so we can talk about what's different. When I did this on Monday, it was concerned that we could see more volatility. Now, Monday, markets were closed because of observance for Juneteenth. It's a new federal holiday, went into effect last year. And so the markets were closed, bond market, stock markets, mortgage markets were closed on Monday. Now, on Tuesday, when they opened, we saw losing a little bit of ground. And I was concerned that we were going to see some volatility. I figured we could see some movement up and down as markets come to terms with the current economic picture. However, a pretty good chance that rates could improve on the weekend. Today, it's looking like rates are improving quite a bit, and I'll talk about that next. But rates did improve a little bit, and it's on the expectation basically that everything's adjusted for this idea that the Fed is going to raise rates more aggressively in July and September, and we'll show you a chart on that. The one thing I wanted to point out, though, that said, we aren't in a position yet to expect rates to fall too far from here. In other words, the one thing about mortgage rates is that rates tend to move up very quickly. Right. We saw rates move up, a 0.5%, 0.75%, even a full percent just over a couple of days. And that's quicker than normal, but they can move up very quickly. They tend to move down much slower. And there's a few reasons for that, but that's generally the pattern that you'll see. Right now, the things that are affecting rates that we're going to talk about now is inflation and ongoing concerns about inflation, and the Fed. Fed Chair Jerome Powell this week speaking in front of Congress. He starts that today. He was in front of the Senate Banking Committee, and he has a twice-a-year monetary policy report that he has to do. So today it's in front of the Senate. Tomorrow it'll be in front of the House of Representatives, the House Financial Services Committee, and today it's the Senate Banking Committee. So he tends to repeat himself over those two, so we kind of watch the first day the most, and he also releases some prepared comments that are written, prepared comments that come out before he even starts his live testimony, which this morning came out pretty good. Now I'm going to jump over. We'll keep that screen up for a minute. I want to jump over. I want to show you guys, just looking at it visually. This is a chart that we've shown you before about mortgage-backed securities. And we've talked in the past about, hey, where do mortgage rates come from? And basically, your mortgage rates, they come from the bond market. And I'm going to show you that fancy chart, and I'm going to show you how that moves. And then they come from lender margins, which is why you always want to shop around. And we've talked about shopping around, and it's important to do that at the same time, especially in an environment like now where rates are moving up and down very quickly. So looking at this pattern, I want to just show you guys, and forgive me that I don't have cool arrows to draw with, but you guys can see the point. We've got a gradual slide. And if you were going skiing, this is a great little ski hill with some nice moguls on it. You've got a nice downward move. And again, unfortunately, as you go down this hill, mortgage rates get worse. They go up. But as you go down, though, I want you to imagine you're skiing. You got a few little bumps here, some moguls and some jumps. And at the end, you've got a nice ski jump and you get to go off. That was when we saw some of the best mortgage rates back at the end of May. And we saw rates that might have been in the high fours for some people, maybe in the lower fives for others. Those were the best rates we had seen in quite a while. And it was a really good sign that through most of May, we had seen mortgage rates stop going up. So the first part of the year, January, February, especially March, April, we saw rates just go higher and higher and higher. And that scares everybody. But in May, we saw them start to settle down. And I had been coming out preaching, hey, I think we've got a nice, equilibrium here. We're finding that balance. And basically what was happening is that the market had priced in and reacted to what the expectations were of what the Fed actions were going to be. So the Fed, I want to show you guys real quick. We're going to show you another chart. The Fed, they are trying to get inflation back in check. Now, the Fed has what's called a dual mandate. Their job is to try to keep employment really high, keep a good employment number, and to keep inflation at or around 2%. Inflation, of course, much higher than that. We're experiencing, inflation up around 8% right now. And that's painful to everybody. And the Fed needs to get that in check, and they've committed to getting that in check. Now, what this chart shows you guys, this is about Fed futures. And this is the probability of what do we think the Fed is going to raise their rate, which is the Fed funds rate, at their next meeting. And we've watched this go over the last few months. We had one in May, we had one in March, and then in May, and then in June, one in June, and then next is July. The expectation for this meeting in June, which happened last week, was at just a couple weeks ago, it was almost a 90, like it is now, like a 93, 95% probability the Fed was going to raise rates by 0.5% last week. And they ended up raising rates at 0.75%. Now, again, when the Fed raises rates, it does lift all rates across, and it's again, not because the Fed controls them, but because of how this environment works. The thing is with mortgage rates, when we expect to see it happen over the next few months, markets will react early and price it in. So we see mortgage rates move up long before the Fed actually takes that action and moves those rates. So when we were expecting to see a 0.5% rate increase in June, markets had prepared for that. We kind of saw rates level out. Well, once expectations were that the Fed was going to need to take a higher rate increase and be more aggressive, the reason for that aggressive rate hike, that higher rate hike, is to slow the economy down faster, to put on the brakes, which will help to fight inflation. If they can get demand down, then that will help to get inflation to come down, because it's all a demand and supply issue. It's how high demand is and how high supply is. So they're trying to get demand to slow down, and they're trying to slow the economy down. They do that by raising this Fed funds rate, which will trickle through and raise rates across the board, and it makes the cost of borrowing money more expensive. So they were expecting to do a Fed rate hike of 0.5%. Instead, then all of a sudden we saw expectations for 1/4 more, for 0.75% in June. Also the same thing in July. The July expectation was also 0.5%. Now that was 0.75%. So when all of this started to get expected, the market started pricing this in early. We saw all of that last week, and we saw mortgage rates just keep moving higher and higher and higher, all in 1 week, as markets just spiraled and went out of control. And it was really, in my opinion, very much like a Chicken Little scenario, where they were running around screaming, the sky is falling, the sky is falling.
Yep.
And the sky's not falling. So we saw some of the worst rates we've seen in 15 years last week because investors, the markets were running around thinking the sky was falling. Well, this week, now they're thinking the sky is falling, but for a different reason, and it's actually helping us. And that's the recession idea. So they're expecting that the Fed is going to raise rates now at higher amounts. At that June meeting, we saw it. And in fact, I feel that the Fed was actually bullied into making that 0.75% hike. I don't think that they would have done that if we hadn't seen the markets just fall to pieces. I think we would have seen a half a point rate hike. I do. I really do. And, we saw that 0.75 point rate hike because markets had already gone off the boat, and now the Fed has to calm things down and they have to get everything under control. So all of this is what's affecting your mortgage rate. And you say, Nathan Hammer, this, I just want to buy a house with an affordable payment. And yet it's all of this stuff that affects your affordability and what you can do. So anyway, so we've seen these moves. The expectations now that these increased rate hikes we'll see them in July. The next meeting after July is actually September. There's no meeting in August. So this has all worked its way into the market, into these technicals that we show you with the fancy candlesticks here. And that means that now that we've worked it in there, now we're free to see the market start to react to this idea. Okay, by doing this, the Fed may put us into a recession and it may slow the economy down too much. And that's going to be bad for things. And that scares the markets. And they move to what's called safe havens. They start to invest more money into bonds. They're parking their money so that they can weather a financial storm. And that's why we're seeing this uptick now, this improvement here that we've seen on these little green lines. And you can see it here in this line chart. As this moves higher, this is helping mortgage bonds. Same thing with our 10-year treasury yield. As this moves lower, that also is reflective that we can see mortgage rates improve. So for those of you that are saying, hey, where are mortgage rates going to go? You can turn the charts off now and we can just chat a little more, Nathan. A lot of you are saying, okay, Hammer, so are rates going to go up and should I still be buying a house now? And it's funny, I've seen a post on Facebook from a lot of mortgage people and it says, marry the house and date the rate. And that sounds kind of like, okay, what does that mean? And what it means is if you're finding a home that you're going to be in for at least the next couple of years, you want to continue to do that. It's still a good time to do that. And the idea is you want to get into that home. And as long as you can afford it, even and qualify, even at a slightly higher rate, let's call it 6% or maybe 6.5%. But we all expect over the next 6 months to a year that mortgage rates are going to come back down. And we think mortgage rates will come down because all these moves that the Fed is taking and raising the Fed funds rate and slowing down the economy, it's going to cause a recession. That recession is going to help mortgage rates to improve. And by the way, I know I'm just doing a lot of talking here, but owning a home is one of the best things you can do during a recession. It's one of the only time we've ever had home values go down during a recession was 2008. And that was due to other variables. There was a lot going on there. Otherwise, this is a great time to own a home. And you guys may be seeing a lot of articles like I do. There's articles on Bloomberg and the Wall Street Journal and CNBC, and I'm sure they're in lots of other sources. And they're talking about home prices are coming down, reductions in listing prices. And yes, that is happening and that's going to happen. But I want to put perspective around that. So in the past, we talked about this, I think, a couple of weeks ago. If Nathan sold his house for $400,000 and I wanted to sell my house and we're neighbors, I might ask for $415,000 or $420,000. And the real estate agents whose job it is, if they're representing the seller, is to help the seller to maximize the profit they're going to get for selling their home. They may counsel them and say, hey, Nathan sold his house down the road for $400,000 in the market based on current projections and how, home prices have been going up 18%, over the previous year and just year over year, just rising. Well, maybe you should list your house for $440,000. Maybe we should even ask for $450,000. Well, what's happened is the people that can qualify for that has reduced because as rates go up, your buying power goes down. And now that means there's less demand, but it hasn't diminished demand enough that houses are sitting there, but it has diminished it enough that now, instead of driving this $400,000 to a $450,000 house and the next house and the next house, prices are starting to come back down. So they listed it at $450,000. It wasn't moving. They weren't getting bidding wars. They weren't getting people coming in and with a line around the block. And they say, okay, Now we're going to go to 440. We're going to go to 430. So the housing market is also finding a more natural equilibrium. And we know that home prices can't go up 20% year over year every year. That's not
Right.
normal. We generally see about 4%.
Right.
So those of you that are buying homes, you may be concerned we're in a bubble. We're going to see a housing market crash. That is still very unlikely. There's nobody expects that. Again, a lot of equity in homes. The people that have been qualified for homes much, much higher than the one time we did have a housing crash in 2008. But what we will see is a little bit more of a regulation, a regulating of those home prices where things are settling in. Some people may lose a little value for the short term, maybe for 6 months or a year, but it will move back up again very quickly. So it's a great time to buy a home. And for those of you out looking, even though rates are high, where this may help you is you may see that there is more inventory. You may not get pushed into that bidding war. You may have heard people that have had stories where they've put in 3 or 4 different offers and haven't been able to get an offer accepted on a home. You now will probably be much less likely to run into that scenario. So that's kind of me. Again, thank you, Nathan. I mean, I know I've been on a roll for about 20 minutes and 48 seconds. So let me let you in now and I just had, it was all bottled up over the last week and a half. We had so many things happening and I've had so many people reach out to me that said, hey, what's going on? I'm confused. What does this all mean? Can you explain it to me? I just wanted to kind of give that explanation. So
I think it was great.
Okay.
I think it was excellent. I do.
Okay.
I really appreciate it. I think people are going to enjoy we'll get back and see. I think for me, because I woke up, I'm checking the markets. I was like, oh boy, here we are. Like, what happened? And I was looking, and then I checked the stocks, and I saw the sell off. And you're right. Once that snowball starts down the hill, people respond. Or emotion is what usually hammers them. And interestingly enough, I'm in the midst of reading some fiction. I like my book for fun is a fiction book always. And this one has a nautical theme. And I was reading about like sailing across large water. And, when a storm's coming and they're turning around, getting into a bay, and they're going to hold off in that bay for a little while and anchor there because it's easier to weather the storm. A lot of people in stocks are like, oh no, the storm's coming, and they sold and they moved their money elsewhere. So yes, all the markets, it's almost to me like tossing a big rock in a pond, and you watch the water push out from the rock, and then it comes back and it goes poof, right, and it explodes, and then it comes out. And what we're seeing here is that kind of maneuver where the water is doing this. And so yes, there's movement in the marketplace, but it's balancing, like you said. So we also are perfectly aligned with how you said when the prices just kept going, and the rates were going down, but what's happening, right? Are prices come down? No, I think what prices are doing are saying, hey, economically, macroeconomically and micro, we're hitting our balance point. Yep. Now they may come down if the interest rate goes up, right? Because they have to keep equilibrium. When things are out of equilibrium, you have fast and immediate change, and that change can go too far, like a pendulum, and it will have to come back. So I agree. If you're in a movement cycle and you have to buy a home, or you want to buy a home, or you're tired of paying this because you're literally looking at interest rates and the house prices around you going, I could afford a mortgage based on what I'm paying in my rent. I should probably look into that. These are things that aren't going to change. Rent does not go down. I mean, I've been on the rent game for a while, but I've never seen it go back to what I rented when I first got married 20 years ago. So I don't think I can rent the same apartment I used to for $450 a month. So keep that in mind. Keep that in mind. Hammer, I loved your analysis there. I appreciate that. I think that identifying there are different market pressures at all times in all positions, and you see it shift, move, and transfer all the time. So that was great. I don't see any questions come in though. So I expect we'll get questions on the replays. And so just as a reminder, if you caught up all the way through this, as Hammer said at the very beginning, drop some questions. We monitor these different threads where we can. So please ask your questions. We'll tag in and try to answer those. And I don't know, man, any last words to share with everybody?
Nope. You and I are going to be meeting each other face to face next week, and we will be at an event. So I don't think we're going to be able to do this on Wednesday next week.
Good point. That'd be the 29th, right?
Yeah.
Yeah. It'd be 29th, and we're in the middle of an event on that for Christine Beckwith with her Vision Summit. So yes, we will not have a call next Wednesday. Thanks for that reminder, Hammer. Appreciate that, sir. We'll be at that event together, and then We'll be back the following week though. So
Yeah.
all good.
For sure.
I'll tell you what. How about this? If anything crazy happens, we'll drop updates under this video for anybody watching.
Yeah.
Let's just type in some updates.
Yeah, we'll definitely have to see, because I'll chat with you. Yeah, we'll definitely figure out something. So sounds
good. All right, everybody. Be well. Thank you, Hammer. And if you have any questions, put them in the comments below.
Yep. Take care, everybody.